In today's episode of Can I Retire, we have Justin and Jessica, hypothetical. They're both 55 years of age and they have $400,000 in liquid assets to retire on. If I jump down here to our retirement software, you're going to be able to see the planning that we're going to do for them today. So their concerns are currently, with about 10 years left of work years, is going to be income. Do they have enough money to last them their lifetime without being a burden on loved ones? Are they in the right investments? How do they avoid their paying more in taxes than they have to? What should they be doing for healthcare planning? And then what about wills and trusts and estates and PODs and TODs and all those types of things to wrap it up with? So those are their concerns. Let's dive into their case and see if you can get some value of what you should be doing in your own plan. So currently, if we jump to the software, you can see that Justin is working for company ABC. Again, this is a completely hypothetical case. He makes about $50,000 a year. He's 55 years of age. His wife, Jessica, works for company XYZ, and she makes about $100,000 a year. And she's 55 years of age as well, too. Now, Justin jokingly says, well, Tony, can we afford to retire right now? They want to live off about $5,000 a month. Well, if I show them as being retired in the software as of this moment in time, and I come over to our retirement tab, you can see with about $400,000 in assets, they're red line. Red line means they're out of money at the age of 62. So that's not going to work. So Justin giggles, he goes, well, I didn't think it would. And so what's it look like if we can make it to age 65? So at age 65, they got about 10 working years left. What should they be doing for the next decade while they're working to get prepared for retirement at the age of 65? So they brought me information, and it shows that Justin's Social Security amount is going to be $1,113, $1,313. And Jessica's is going to be $2,166 in Social Security benefit at the age of 65. Now, I'm not saying that's when they should turn on their Social Security. It's just what they were asking for. So we'd want to analyze when is going to be the best time to maximize that Social Security as well. If I go over to the cost of living adjustment, we all know that Social Security most of the time gives us a little bit of a raise each year in January. So if I come over to the cost of living history adjustment, you can take a look at the 10-year average has been 2.75. For the last 50 years, it's been 3.70. I'm going to use the lesser of the two, 2.75. And often I'll even use less than that to be very conservative. So let's jump over to tab number 2 up here at the top. Go and take a look at their assets. So on their assets side, you can take a look at their checking account. They have $1 in their account. That just represents money in, money out. They don't have a large dollar amount sitting in that checking account. I come down to the second line, their savings. You can see they have about $25,000 in savings, and they're also contributing $250 a month into that emergency or savings account. Justin has a 401k at his work. It has $100,000 in it, and he's not contributing to his 401k. So here's one red flag right to start with. Is Justin getting any sort of a match? Is Justin missing out on free money? Why isn't Justin contributing to his 401k? If the company's doing a match, it's probably a no-brainer for most people to at least contribute up to the match. And in this case, he's not. So we'd want to double check that and why. So Jessica's 401k, she has about $300,000 in her 401k, and she is doing a great job of saving money in that. So she's got about $1,500 a month going into that plan. You can see that they have a home that's free and clear. They don't owe anything on it. And that value of the house is worth about $350,000. We come down, you can take a look at the kind of a total net worth here of about $775,000 with about $425,000 technically in liquid assets. Going over to their expense tab, they say, hey, listen, in retirement, we think that we should live off about $5,000 a month. We can do that very comfortably. We don't do anything elaborate. We take a vacation every now and then. We like to go and spend time with the grandkids when we have them. And the biggest fun conversation is always about the average inflation rate. And you can send me hate comments in the bottom or emails at least. And there's always a big discrepancy of what you believe that the inflation factor is going to be and how it's based, how it's calculated. I get it. I'm on your side. We'll run it however you want for your particular case. The current 10-year average in the software that we're using shows us it's 2.82. For the last 110-year average has been 3.27. How they calculate it is a debate for another time. So if we do that, we say $5,000 a month, that's after taxes dropped into your checking account to live off of. Now we've kicked on the Social Security at 65 years of age. We go over to our retirement tab and you can see that they get redlined. How long the money lasts is now goes to age 93. So not bad. Not bad. I'd like to see it in the 90s. I'd like to see it a little bit higher, maybe in age 100. Gives us a chance to hit some more curveballs out of the ballpark if we need to, if we're throwing some interesting things our way during our lifetime, whether we have health problems or vacation, we need to do home improvements. All of those things I call curveballs. So at age 65, you can see right here, we've got Justin's and Jessica's Social Security turned on. And if I come down to the next tab down, you can see that cost of living adjustment is giving it a little bit of increase each year, down to the next year, down to the next year, and the next, and so on. And if they want about $5,000 a month with inflation, well, they're gonna have to pull out about $33.24 in this first year per month out of their liquid assets to maintain their standard of living. And you're going to see with that average inflation that they're going to have to pull out a little bit more every single month to maintain that standard of living. Off to the far right, you can see their liquid assets slowly growing here, but then you can see as that cost of living continues to grow, that the liquid assets slowly start coming down when they get into their 80s and 90s, all the way down to age 93 when they redline with no more money. Now I'm being pretty conservative here. I'm only using about a 5.5% rate of return on those assets. And this the protected asset is just simply their home. I think I gave it about a 1% increase per month. So nothing crazy, but they still do have the value of that house if they ever want to downsize or sell or need to move to assisted living or full-time living, nursing facility type situation. So I'm being very conservative on that side as well too. So 93 isn't bad. But one thing I want you to go back and take a look and notice here is under the assets tab, a majority of their assets, what is that, 90-some% of their assets, is all sitting in qualified money, meaning it's money they've never paid taxes on. Let's talk about the pros and cons here. So in a 401k, you're going to get the benefit of a tax deduction in that calendar year. And then you plow money into this 401k and you're telling the government, you're saying, hey, listen, I'll defer the tax later down the road. And a lot of us have all been told, hey, don't worry about the taxes because when we retire, we'll be in a lower tax bracket. So maybe that's true for some of us, but I find for most of my clients, it's just not true. And a lot of them are retiring and they're making the same amount of money, or they believe that taxes 5, 7, 10, 15, 20 years down the road are going to be higher. So even let's say that you're making $75,000 or $100,000 a year in retirement, or whatever that dollar amount is it possible that 5, 7, 10 years down the road that you're making the same amount of money, but they change the tax brackets on you, that you could be in a higher tax bracket, not because you're making more, but simply because the government changed those brackets? Well, of course it. So if you believe that taxes have a probability of going higher, then you might want to consider of doing some Roth conversions, putting some of this money into other tax-free places, having a better balance between your qualified, your after-tax dollars, your tax-free money. So I've talked to Justin and Justin says, you know what, our company does not do a match. I'm like, okay, they're not doing a match. Yes, you can contribute to the 401k, and if you qualify, you get a standard deduction in this calendar year. But you might consider, just might consider, not for everybody, but does it make sense for you? And let's go in here and let's put in a Roth. Let's put a Roth IRA for Justin. Justin's over the age of 50, so let's just say he can do up to about $8,000 this calendar year. Let's just say he's doing about $650, which puts us real close to the $8,000 mark. And let's see how that changes his retirement plan. Remember, the money ran out at age 93 is when they got redline. And they say they can afford an extra $650 a month for the next 10 years before they retire. So I plug that in, it's after-tax dollars, and they jump from 93 years of age up to age 98. So it looks a lot better. They added, about 6 plus 5, 6, 7 years in there in retirement. And now we've got some better balance going on between their 401k plan and their Roth money. And when does it make sense, or does it ever make sense to do Roth conversions? While they're working, after they're working, all those things need to come into play. So today I just wanted you to think about your situation. How old are you? Are you in your 50s? How many more years left do you have to be working? Are you putting too much money into your 401k? Most people, it's a great idea to put up to the contribution limit and then maybe redirect some of those dollars, if you think taxes are going to be higher in the future, into some tax-free places. So I hope you got some value out of this. If we can ever help you out, we're always here for you. You can reach out to us. Our information's in the comments below. And as always, remember to consult a licensed professional who understands your specific goals and dreams.